We all know the spokespeople, right? We know Flo from Progressive, we know
Yes.
Jake from State Farm. And so I think a lot of people are swayed by that kind of advertising at a point in time when they're buying a house. And that's what prompts them to choose an insurance policy, not necessarily shopping around and finding the right price. And I think the sort of model of this automatic renewal for most insurers locks you into an insurer for a long period of time. And because of the way it's paid through the escrow, you might not even be aware of, oh, did my policy go up 3% last year or was it 12%? Well, it's tied up in my mortgage payments or my property taxes. So, I think a lot of this is really shrouded for most people. I think most people aren't shopping around very aggressively. And I think for most people, there's probably opportunities out there to shop around and find a deal that's a bit better for you.
Hey everyone, I'm Jean Chatsky. Thank you so much for joining me today. Before we get into today's show, I just want to say that my team at HerMoney and I are thinking of all of you who've been impacted by Hurricane Helene, Hurricane Milton, the hurricanes yet to come. Even if you weren't in the path of these storms, chances are pretty good that you know someone who was. And this process of rebuilding, relocating can be hugely arduous and stressful. So you are on our minds. And if you were not impacted, but you're looking for places to help with donations, World Central Kitchen, the American Red Cross, All Hands and Hearts, and AmeriCares are all great places to start. Look, folks, this is nothing new. Every year, during hurricane season, we see that many of you in our Her Money Facebook group have questions about homeowners insurance, and I get it. It is so difficult to know exactly which policies are right for your specific property, your specific needs. I think we've all heard horror stories about someone who had homeowners insurance but not flood insurance, which meant that they were covered for wind, but perhaps not water. Look, I don't want any of you to find yourselves in a situation where you're underinsured, but by the same token, there's also not a lot of upside in being overinsured. So today, we thought we would dig in and look at things related to homeowners insurance, answer some of your biggest questions. Joining me to hash it all out is Ben Keys, the Rowan Family Foundation Professor of Real Estate and Finance at the University of Pennsylvania's Wharton School. His research found that climate change is driving homeowners insurance rates higher, but not always in the parts of the country that are at the greatest risks. And if you've been a longtime listener, you might remember Ben. We had him on in 2022 to talk about how war impacts the markets. Ben, nice to have you back. Thank you so much for joining us.
Yeah, absolutely. Thanks so much for having me.
So, according to a recent bank rate analysis, premiums are up. Homeowners insurance premiums are up 23% since, I believe, 2023 across the country. That is an enormous increase. And it's not just extreme weather that is driving it. Why are rates rising so far so fast?
Yeah, rates are way up relative to where they were just a few years ago. I think you can trace out the drivers and put them into a few categories. One is just inflation, that we've seen a rising cost of materials and labor, the kinds of construction costs that insurance companies have to deal with when it comes to repairing a roof or dealing with water damage. Those kind of costs have gone up. So they're passing those costs on to homeowners. I think a second category of costs is related to what's gone on in capital markets, where we've seen rising costs of reinsurance. And this is can get very technical and in the weeds, but reinsurance is essentially the insurance that insurance companies use. And so think of a big insurance company that is writing out a lot of policies. They're worried about a big set of concentrated claims in a given geographic area. And they're going to take out an insurance policy, pass along some of those premiums to a reinsurance company that's going to provide them insurance. And these reinsurance companies are generally working at a global level. They're working across the world in thinking about how much should we charge for different types of concentrated risk. And one of the things that we've seen is that the price of this reinsurance has basically doubled since 2019. And so there's been a very sharp increase in the costs that insurance companies have to pay in order to protect their downside risk, and they are passing those costs on to the households themselves. The last category of drivers of cost is the shift from zero interest rate world to a non-zero interest rate world. And so there was a time where the cost of capital was very cheap for these companies. They could borrow at a very low interest rate. They didn't need to provide very large returns for their investors. And now we're seeing that the cost of capital for insurers and reinsurance has gone up dramatically in the sort of post-inflationary world, and they're passing on some of those costs as well. So there are a number of drivers that are increasing the cost of insurance, but some of those drivers are hitting homeowners who live in disaster-prone areas more directly than others.
Talk about your work a bit. I mean, it's very surprising that consumers who don't live in the areas that we think of as being the hardest or most frequently hit are being hit with big increases.
Yeah, I mean, so my research in this area is partly grew out of earlier work on flood risk and trying to understand how that's affecting housing and mortgage markets. And very quickly, when you'd have conversations with people in the industry, they would say, well, this is the insurance sector's problem. This isn't our problem in the mortgage market. So we said, okay, well, where's the data on insurers' premiums and how much it actually costs to insure a property? And we had a lot of trouble finding good data on the cost of insurance. And we looked around and really couldn't find a representative data set. And so we decided we needed to build one ourselves. And so we did this using mortgage data. We realized that you could back out how much people are paying in their homeowners insurance from their mortgage escrow payment. Most homeowners with a mortgage pay into an escrow account where they're going to pay the principal, the interest on the mortgage, but also contribute to their tax payments and to their insurance payments. And so you can kind of back out the residual amount in there as the homeowner's insurance. And once we cracked the code on that, we realized we had a data set of about 47 million homeowners insurance payments. And what that revealed was this big increase in the cost of insurance over the last few years. Insurance has gone up by almost 35% from 2019 to 2023. And you mentioned it at the top, that additional 20% increase just in this past year. So it's continued increases, but it's not happening evenly across the country. And it's going up much more sharply in areas that are exposed to disaster risk. You mentioned this idea of premiums rising in places where you might not expect them to. I think there's a couple of factors there. One is it's not necessarily obvious to people who don't live in some of these areas just how exposed to risk some parts of the country are. So we saw places like Oklahoma and North Texas jump off of our map in terms of expensive places to find insurance. That's really a function of hail and tornadoes and the kinds of disasters that affect that part of the country. There's also other issues in terms of regulatory frictions. Some states make it difficult for insurers to raise their premiums as much as they would like. They have to go through an extensive review process. And research by Ashita Sen at Harvard Business School and others has shown that these regulatory frictions matter. And so think of it like squeezing a balloon. If an insurer wants to raise premiums in one part of the country where they're a bit constrained from doing so, they instead increase premiums across their network. And so even places that are sort of less risky may be bearing some of the brunt. It's hard to estimate the exact amounts of how much is my insurance in this safe part of the country gone up relative to some of the riskier places. But I think that channel is an important one to try to understand.
I think this is something that sort of falls into the domain of we need to try to control what we can control, right? We as consumers and homeowners can't control the storms. We can't control really if we're in a flood area or not. And many places that you wouldn't suspect were in a flood related area have shown that they actually are. We can control potentially buying enough insurance and making sure that we have the right type of coverage. And yet, one of the things that we saw coming out of the reports of Asheville and the terrible damage from Hurricane Helene was that many people were woefully underinsured. Across 7 states impacted by Helene, less than 1% of the people who lived in inland counties had flood insurance, in part because they hadn't flooded in over a century, but it didn't mean that they couldn't flood. So, how do we know if we have enough homeowners insurance to begin with? And then how do we know if we should be buying flood insurance on top of it?
It's a great question. I think there's a couple of steps that we all need to take. The first is a better diagnostic of the climate risk that we face in our house, trying to understand what are the risks that we're facing and how likely are they to occur, and then what would the costs be if those events did occur. Getting good data on these climate risks is often challenging. I usually tend to point people to the First Street Foundation. They offer a climate risk assessment of any property in the country. You can go to their website and punch in your address and get some sense of how risky it is. You can talk to your neighbors and realtors about the experiences in those neighborhoods in the past. And you can look at public data sets as well that the NOAA provides and some other government websites, including the National Risk Index, which is one that we've used in our research. And the National Risk Index breaks out every type of disaster or type of potential climate risk. And so whether it's flooding or fires or hail or tornadoes, you can get a better feel for how likely you are to be exposed. The other group to talk to is talk to the insurance companies, because the next step is then drawing that link from the actual kind of risk level to how much you want to pay to protect yourself from that risk. And so you need to recognize that different policies cover different types of risks, different perils. I think it's a misconception that floods are covered under homeowners insurance across nearly every policy in the United States. Flood insurance is almost always carved out into a separate policy. And so you need to start looking into what those policies cover and then shop around for the best policy.
One of the things I think people sometimes forget is that if you've been in your home a while and have been fortunate enough to see your property value go up, if you haven't gone back and repriced your insurance and you have any sort of a disaster and you need to rebuild in a significant way, you're not going to have enough coverage, whether it's because of simply the inflation in prices or because you added some stuff. We did a renovation, my listeners know, at our home in the beach. Over the last year, we put in an elevator, right? The homeowners insurance company came right in and said, this is going to be, I think it was like $800 more a year for that elevator, which was like, ouch, but I should have expected it.
This is such an important point. So most of the time, people do not update their insurance policies over time. They sort of set it and forget it. It becomes a very automatic renewal process. You kind of shop around at the time when you might be buying a house or maybe when you're refinancing the mortgage, but usually you're going to stick with the same insurance provider year after year. And so this point that you're making, that the amount of coverage that you've contractually negotiated at that time is going to stay usually fixed, even as the value of your home might change or it might change due to renovations. So you want to make sure that you're keeping up in terms of the amount of coverage to cover the value of the structure and the value of the contents of your home as well. And so I think that's an important piece. There's one more thing I'll add to that, which is your credit score is a really important driver of the cost of homeowners insurance in a lot of states. And I think people understand this about auto insurance, that auto insurance is closely tied to your credit score. But in most states, insurers are allowed to price differentially based on your credit score for property insurance. And so if you've had a big improvement in your credit score, you've been working hard to move up to a higher credit worthiness standard, your insurance costs are actually going to fall dramatically. So you should be shopping around anytime you have that type of experience where you've improved your credit score.
Why is that? Why does credit, I mean, I think I understand it, but from your perspective, why does credit matter?
Yeah, credit matters is as a dimension that insurers have fought for a long time to be allowed to price on. There's a set of variables that they're allowed to price on and a set of variables that they're not. So they're not allowed to discriminate against race or gender or other kind of characteristics when it comes to property insurance. But in many states, they're allowed to price on credit score. They argue that it's because people with different credit scores are differentially likely to file a claim. And so people with low credit scores may have very low deductibles. They don't have a lot of household cash on hand. And so they're going to be more likely to file claims, more likely to hit that deductible limit. And that just leads to more fixed costs that are going to be borne by the insurance companies. Now, that said, we actually haven't really seen much data coming out of the insurance industry to know whether that's true and whether that lines up that lower credit score homeowners file more claims than higher credit score homeowners. It may also be a function of the neighborhoods that they're in, the types of risks that they face. There may be more petty crime. They may actually be more exposed to disaster risk in lower credit score communities. But that's, I think, some of the explanations for why they have lobbied these state regulators to be allowed to price along the credit score dimension.
I know people personally who have been ditched by their carriers, not even in cases where the carriers left the state, although that has happened as well. If your homeowner's insurer says bye-bye, what do you do?
Yeah, insurance companies don't have a lot of requirements for sticking with a homeowner. They can decide to drop a policy pretty flexibly. They're a fairly nimble industry. And so if an insurer drops your policy, the first step is to shop around, try to get some price quotes and see what the rest of the market is offering. In some cases, you might actually find a cheaper option than what you were paying previously. Again, to this point that people fail to shop around aggressively in this market. So going out and getting price quotes either from a comparison shopping site, talking to an insurance broker, or just spending a couple of hours reaching out to a few of the big carriers and see what they're offering in your neighborhood. What we've seen in some of the most extreme areas is that there are no private carriers that are willing to offer a policy. And so in Florida, for instance, Citizens Property Insurance has now become the largest insurer in the state with over 1.2 million policyholders. That's a public entity, right? So there are no private players in the market that are willing to offer a policy. And so if you are finding it very hard to find a private traditional insurer, you may need to go look for a state insurer. And these are called state fair plans, FAIR plans, that are present in about half of all states at the moment to try to step in and fill this void.
If you're looking for any sort of indicators on quality of these state fair plans, can you look at the same sort of A/B ratings that you might look at with national carriers, the S&P ratings or the Fitch ratings or the AM Best ratings?
So unfortunately, the state fair plans, there's just one of these plans per state. So you don't have a choice to shop around in the given state. It's either that or a private carrier. And so they don't go through the same rating process as a traditional private player. And they tend to offer sort of less coverage at a higher price in many cases because their pool of properties that they're insuring is so negatively selected, right? These are essentially the pool of properties where the private market is saying we're unwilling to write a policy at a reasonable price, and those tend to be the riskiest properties. And so the state entity is left with a very adversely selected pool of risk.
Two excellent New York Times reporters, Ron Lieber